Risk comes from not knowing what you're doing. Warren Buffett. Simply put, risk management is what separates a trader from a gambler. If you have weighed the pros and cons of a trade idea and you have a trading plan in place, then you're simply trading what you believe are favorable odds.
Welcome back to Book Club. We are going to jump back into chapter 5. Let me find my spot. The last read was a little bit long. This one will be a little bit shorter for no real reason. Okay. All right, so we were on combining indicators with trading rules. Okay, so combining indicators with trading rules. The key to technical trading success is being doubly systematic in identifying what are for you tradable trends and conditions, and systematic in applying your trading rules. Trends can be defined by dozens of different criteria. As I show you in part 2, a trend defined by a simple measure, such as 2 or more touches of a support line, gains credibility when you can add a confirmation from a second indicator. Such as a volume, momentum, or relative strength. All indicators fall sometimes, so a trend can be deemed more reliable if it is confirmed. By the time you add a third confirming indicator, your confidence level should be pretty high that this will be a winning trade. But price series seldom cooperate and deliver confirmation after confirmation from multiple indicators. In fact, by the time everything lines up perfectly, the trend is probably ending. It drives some people nuts to have 3 indicators saying buy and 1 saying sell. But trust me on this, that's exactly what you'll face almost all of the time. Depending on what indicators you choose and how well they tend to perform on your securities, you should rank trendedness by your own measures of reliability from real life experience. You can take guidance from statistical work on reliability by analysis, by analysts like Bolkowski, see chapter 9, but you need to remember that even though history repeats, it never repeats exactly. This is why book authors and other gurus who claim to have ideal indicators for their securities aren't necessarily lying. Maybe they did for their securities and in the time frame they were working. That doesn't mean their magic formula will work for you on the securities going forward and with your risk preferences. It's therefore better to master the principles behind many different indicators and understand why they work so that you can be flexible in choosing the ones that work for you. It took me 20 years of looking at it every blessed day to get the Fibonacci retracement concept. It's now on my list of must-haves, and I still look at it ahead of every trading decision. Ranking your indicators as to their value and meeting your trading rule criteria is a personal job. Not all indicators are created equal. The zippy indicator that yields good gains for the high-frequency trader may entail too much risk for you. The reliable slowpoke indicator that's hardly ever wrong may get only minor gains as well as put you to sleep. Trading styles. There are as many trading styles as there are individual traders in the world. I propose a way of looking at trading styles that aims to blend indicators with rules, but it's very general. System mechanical trading. Truly systematic traders take every trade that their indicator system dictates. Indicators are selected because they deliver the desired risk metrics, but after the design phase, the indicators rule. The actual trading is not only mechanical, but also literally can be done by a computer. 2 major system designers are Keith Fitchen, hopefully I'm pronouncing that correctly, and Perry Kaufman, each of whom has written an excellent book on building trading systems. See the appendix for additional resources. If you're a computer whiz, you absolutely positively need both books. System design that blends indicator choices with risk management rules is very advanced stuff, but after the system is built and tested, you can sit back and let them rip. In the system mechanical world, especially if indicators are adaptive to changing conditions, you apply no judgment after the design phase. You don't sit around contemplating noise versus event. Worry about contingencies. A successful system should be robust across all conditions. System guided trading. Say that you've developed a set of indicators that deliver the mix of percent gain, gain loss, and so on that you prefer. But sometimes it fails to live up to expectations. This generally occurs during retracements, but also when trendedness collapses and the lack of trendedness. The dreaded sideways movement. It's very hard to modify indicators to be adaptive in both both trending and non-trending situations, and it's equally hard to identify precisely when trendedness is giving way to non-trendedness so that you can change to a different set of indicators. Not all trends are created equal. In system-guided trading, you want to apply additional techniques usually from the non-mathematical collection like candlesticks and other patterns, to help you modify your trading style to preserve your trading rule goals. In other words, your trading rules are more important than your indicators to lasting success. You don't discard your indicators, but you have a healthy skepticism about their usefulness in untrended conditions. How does this work exactly? You have 3 tactics to consider. Number 1, embrace the idea that you don't have to take every trade. When your chart is a mishmash with no obvious directional bias, your indicators are still pumping out buy-sell signals that are mostly wrong. Don't hate your indicators, it's not their fault. Just accept that they aren't reliable under these conditions, and because your priority is to preserve capital, don't trade. This doesn't include cherry picking, meaning taking some trades and not others. Doing so is almost always self-defeating and causes confusion to boot. You start thinking your intuitive feel for the security is better than the indicators. It's not. Once in a blue moon, it may be, but don't count on it. Just stop trading until you see trendedness return. Number 2, change your time frame. Say you consider yourself a position trader with a holding period of months, but along comes a choppy chart with high volatility, meaning a wide high-low range. Instead of sitting it out, twiddling your thumbs until a trend emerges, trade the choppiness on a swing basis using patterns of other techniques. This proposition is also iffy. It entails changing horses in midstream. Again, you can easily get confused. Number 3, adapt your risk management rules, stops and targets, and perhaps scaling in and out to the new conditions. If you've been setting profit targets as a function of average range and stops just below support levels, but support levels are broken or can't be found in the new environment, devise new stops that still preserve your gain-loss ratio. Guerrilla trading. The term guerrilla trading is mostly used by one school of analysts that specializes in sideways markets, special setup situations, but it can be used in other contexts. In military terms, a guerrilla engages in irregular fighting, meaning he is the one to choose his time and place, not the enemy. Guerrilla trading is the least systematic method of trading and relies on special pattern setups and/or astute intuitive feel for crowd psychology. An example is stipulating a buy entry order below the current level but still within the normal range, because the desired target would be outside of the normal range and therefore not likely to get hit. In other words, the market isn't offering you a profit opportunity at current levels, but could easily go to your preferred levels while you aren't watching. If the price falls to the guerrilla entry, you have a fighting chance to hit the target, but the trade isn't otherwise worth doing on a gain-loss basis. A parallel guerrilla tactic is seen with blinding clarity when a stop should be placed and determining the entry as a function of the stop. Again, if the entry isn't hit, the guerrilla trader doesn't care. The trade was worth doing only on his terms. Individuals can't tell markets what to do. Of course, you and I are always price takers. But if a better entry is possible using average range or other concepts, why not try? In non-system trading, you don't have to take every trade. Guerrilla trading comes in at least 2 flavors. Number 1, guerrilla trading can take the form of entering and exiting an existing trend multiple times, each with a deliberately short time frame, like a few minutes, but staying out of the market or reducing the stake or scaling out when the trendedness ranking is low or medium. It may also entail tactics like specifying non-market entries, as I described earlier in this chapter. To a certain extent, using a trailing stop is a guerrilla tactic, although trailing stops can be system mechanical too. Number 2, as a subset of guerrilla trading is setup trading, in which trades are inspired by a shock that results in specific bar configurations, especially in candlestick form, of patterns like gaps. The shock, especially if noise, is expected to be short-lived, so the exit depends on time, usually a very short holding period or dollar gain loss rather than an indicator. Knowing how much is enough. When you have a gain in a trade, how do you know when to take profits? Unfortunately, few experts offer guidance on how to design a take profit rule. You never know at the beginning of a trend how long it will last or how far it will go. The central issue in managing the trade is that you can have control over the size of your losses via stop losses, but very little control over the size of the gains. You can buy a stock at $5 and make sure that you only lose 2, but you can't force the stock to go to 9. In practice, each individual trader develops his own technique that is a combination of risk analysis and indicator readings. The optimum way to take profit is, in fact, one of the great unexplored frontiers of technical trading. Here are some of the choices for selecting a profit target. Number 1, name a dollar amount. Logically, Logically, you want to gain that as multiple of the risk you're taking. Say your security costs $8 and you want to lose no more than 25% or $2. You can place a stop at $6 or $8 minus 2 or a smaller amount like $1.50. Your profit target is double initial risk or $4. This is a 50% return, which may or may not be realistic depending on your holding period, changes in volatility, and other factors. After you have made the 50%, however, you obey the target and exit the trade when it reaches $12. The problem with this approach, of course, is that the price may keep on rising and then you have an opportunity loss if it reaches, say, 20. Number 2, set up a true range amount. Your security historically has an average high-low range of $10 over 20 periods, your expected holding period. You want to capture 75% of the range, or $7.50. Because you use indicators to time your entry, you assume that you're entering at the low end of the range, therefore 75% is realistic. When the price reaches your target, you take profit. The problem with this approach is twofold. The range can widen or narrow. If it widens, you aim too low, and if it narrows, your original target is too ambitious. A pullback can wreck your expectations. You may have met the goal of entering at a low, only to have an aberrant pullback take the price down 30% rather than up 75%. This movement wasn't enough to hit your stop, but now your profit target is $10.50 away from the current price. Because you know the average range is $10, the probability of meeting your $7.50 target within your holding period just went out of the window. Rely on indicators. Instead of forming take-profit rules, most technical traders rely on indicators to signal when a move has ended. The signal is the de facto take-profit rule. Relying on indicators is likely to result in the biggest gains, but doing so requires more market monitoring than the fixed dollar amount or average true range methods. Consider the measured move concept. For some patterns and theories about price movements contain a forecast of how far the price should go. See Chapter 9. Some evidence shows certain measured moves can be trusted to appear X% of the time, but not every time. You're welcome to test the measured move concept on the price history of your securities and rank measured move as an indicator, just as you should rank your other indicators for reliability. All right, cool. We're gonna stop there for today, and we will explore controlling losses, which is massively important, the next time. Thank you for joining. Peace.